And welcome. This is Mary Ellen McGonagle with the MEM Edge Show. And this is the show that's brought to you each and every Friday afternoon. And it's the show where we put you in front of where the action is in the broader markets. Lots of volatility out there. However, I would argue there are some themes that are beginning to emerge out of the ashes, if you will. So we are going to take a close look at what that looks like, as well as a lot of other areas that we can really dig into and get a sense of precisely where we are, where we may be headed. So let's take a look at our agenda for today. As usual, we are going to take a really close look at the current markets. Where exactly are we? Another down day today. How does that relate to history and so forth? And then also there are areas of the market that are seeing potential growth in the face of the current coronavirus environment. So we are going to go ahead and take a look at some of those stocks, those areas, and also stocks that are attempting to reverse their strong downtrends. And of course, the markets are down over 30%. We are seeing some individual stocks down as much as 50%. And some of those names are attempting to reverse those downtrends. So we're going to look at those stocks, and then I'll share with you what I would need to see to be convinced that their downtrends were potentially closer to being reversed than not. So that'll be fun. And then also using history as our guide. We're going to go back, take a look historically at some other periods of the market, always with an eye toward helping you gauge not only where we are, but have a really solid plan if you are active, if you are still in these markets. So let's go ahead and get started. This first area, as always, I do want to, in fact, before we begin and get into the broader markets, there was one other historical precedent chart that I did want to take just a momentary sidebar here and share with you. This comes from Robert Shiller, famous Yale economist, and it is from his data bank and database. And so what we are looking at is bull and bear markets, and it's going back to the turn of the last century, 1903, taking us to 2016. And in essence, these blue areas are the bull market phases going back historically. Down on the bottom here, we have the various time periods. And then in the orange is the actual bear markets that have occurred over that time period. And really, in essence, what I did want to share with you is how historically, when we really zoom back and take a look at the S&P 500, the broader markets in general, and again, this is an over 100-year time period, we can see that while these bear markets can be quite painful, certainly this is the 29 bear, super painful, but we can see other periods as well, including that 08, 09, and so on. But in essence, the bull market periods are quite a bit lengthier in their duration, and certainly the upside potential out of these bear markets is really quite it can be very, very profitable. So really just zooming out to give a bigger picture feel for those of you that are potentially feeling a bit panicked, know that these bear market periods do not last forever. And then again, that period coming out can be really quite productive. So that was one thing I wanted to share with you based on history, but let's take a look at the current market environment. This is the S&P 500 large cap index. We're looking at a weekly price chart. I'll remind you again that this red bar is the red line is a 10-week or 50-day simple moving average. The blue is a 40-week or 200-day simple moving average. And during normal uptrending bull market phases, these are very effective simple moving averages as indexes to indicate where we may be during an uptrending period. Now, certainly more recently, we've had these super dramatic, almost unprecedented, sharp breaks. So really all of this near-term view has gone out the window, for lack of a better word. And as we continue to break through huge volume characteristics, really just quite a bit of fear, and it's certainly warranted in a bit, in a way. So we can see these big drops, and really what that tends to do is take this concept of looking for possible areas of support, kind of removes it a bit, but I am still going to work with that, because as we saw the markets deteriorate from that February peak in price, the first area of support were these simple moving averages, sliced right through that in the matter of 2 weeks. And then subsequent to that, this week, the next area to look for support was the lows of that 2018 bear market. And the level there was 2346. And it was holding in until today. Today's downside action in the markets did push us down below. So I'm going to share with you a longer term view. For those of you that we can just share the next possible area of support that's on the radar. And the reasoning here is because these numbers are generally broadly viewed by market watchers, by bigger institutions. So it's worth noting, again, the volume characteristics here, but a couple of things I want to share with you while we're here on this weekly chart. Up on the top here, I have what is called relative strength indicator, RSI. Again, we can see during these nice uptrending periods, the RSI is heading north. It's above this net neutral dashed line. And again, during this more recent uptrending period that took us into February. But now we can see the RSI, unfortunately, is in negative territory, below 50. But take a look, because the RSI is in what's called an oversold position. When that RSI gets below 30, it is viewed as being oversold. For those of you subscribers to my MEM Edge Report, it comes out bi-weekly, but also alerts throughout the week. They are going to probably know my next sentence, and that is an RSI that is oversold is highly unusual when you are looking at a weekly chart. And there is relevance to that. When a stock, when an index does emerge and go into an oversold position, the downtrend reversal or the rally out of that oversold position can be very constructive. So I'm pointing this out to you as one potential bright spot. We can go back to 2018. It never got into that oversold position. I'm going to have this in my newsletter this week, taking you to 2 periods where it did get into oversold and what it looked like coming out of that oversold on a weekly chart. But really, it is encouraging. I would point to this as one very early potential bright spot for the markets. Let's go down here to another technical indicator. I like to use stochastics when we're looking at the broader markets. This is another momentum indicator. And once it breaks below that 50, it is in negative territory. And we are also in an oversold position in the stochastics. And again, the relevance here is that when we get into these oversold positions, it does allow potentially for that reversal. This is taking us back to that 2018 bear market phase. And the stochastics coming out of an oversold position, that's an early signal. So I'm going to keep my eye on that. I would urge you to do the same. So that's the broader markets. I am going to share with you one other view of the S&P 500. Looking at a longer term chart. This is a monthly view of the S&P 500. And a couple of things I did want to share with you here is that on a longer term, we had the RSI now negative on the weekly. And we had that former support area. I talked about that low of 2018 being broken. The next possible area of support could take us down to these 2016 lows. That is 1800. I am not anticipating that. And again, with that, I hope you'll take advantage of a trial period for my newsletter. I'm going to get a little bit more into why I'm not anticipating that significant of a drop. So that was just a longer term view that I did want to share with you. This 2018 low is 21% below where we are now. So let's go ahead beyond the broader markets, take a look as we do at some of these sectors and get a feel for where we may see relative outperformance. And so what we are looking at here is what's called a candle glance view. It's looking at not only the S&P 500, but also each of those 11 underlying sectors in the S&P. So what I like to do is add this RSI indicator. You can add the indicator of your choice. And I'm looking for relative outperformance descending. So I want to see strength. Now, strength is all going to be relative, of course. We are in very much a downtrending period in the markets, but take a look. This is something that I find really not only encouraging, but there are sound reasons for the fact that technology is up here in the forefront. This is something I look at regularly. Yesterday, tech was over here, staples were first, but tech is emerging. So as we drill down further, I'm going to share with you precisely why. There's two natures and reasons why tech is holding up better than the broader markets, and you're going to want to know about it because there are opportunities within there, not only currently, but certainly for when the markets reverse. These stocks that are withstanding the broader market downward pressures are going to be your leaders in the next cycle. So from here, we can see continued self-defense, staples, healthcare, and then communication services is viewed somewhat as as defensive because the need for telecommunications. But of course, we are in a period with confinement where a lot of these live streaming companies are holding in well. Let's go down to some of these weaker areas, and I can share with you some of the reasoning there. This move down in utilities for some may be really super surprising. These are higher yielding stocks. You have a concept that there is a need for energy regardless of the economy. But a lot of this is because if particularly in Europe, areas that have confined themselves prior to US, they're seeing a really reduced demand in energy because these corporations, they were big utilizers. Another area is real estate, huge decimation here, normally a defensive area. And a lot of the disappointment and the areas that are not doing well in these REITs are housing, lodging, hotel, retail, those areas that are expected to take a great period of time to recover. I'm going to have to take a little bit of a break. When we get back, we're going to take a look at the markets again and share some of those bright spots with you. So we will be right back. And welcome back. So where we are now is, again, this candle glance view. It's providing a 2-month daily price chart snapshot. And beyond the sectors, I like to drill down into other areas of the market. So we have the NASDAQ, the Dow Industrials, and also the small cap stocks, but I like to put in biotech, semiconductor stocks, software stocks. Those of you that watch my show regularly know that those are areas that I do like to really pay attention to. They provide unique outperformance opportunities in bull market periods, but surprisingly, we are seeing outperformance during this current bear market as well. Again, that RSI in descending order. I'm going to go ahead and update it again. And so here we are. This is the US dollar. That is just worth noting that it is hitting certainly near-term new highs. But beyond that, we can see that the volatility index remains really quite high. We can blow this up very quickly. That 80 level, 85 historic highs, we are still up there at 66. So volatility volatility remains really quite strong. And beyond that, take a look in this third grouping. This is again strength to weakness. Biotech stocks are really holding in well. Now, of course, that will make quite a bit of sense given that the current pandemic that's taking place is going to impact healthcare, but in particular, these biotechs. So biotech stocks are only down 5.5% this week, and that is as compared to the broader markets down 13.5%. So I'm going to get into some of those biotech stocks that are outpacing and go into precisely why. But take a look. This from my today's work, I will share with you is the most interesting, and that is this ETF, IGV software stocks. Very interesting that software stocks are up here in the forefront on a relative outperformance basis. This grouping is down 9%, not for the faint of heart, but certainly better than a 13.5% decline in the broader market. So we are seeing, I'm going to blow this up, we're well worth noting, we are seeing a bit of bottoming here, and this is where we are seeing a lot of those sharp reversal attempts. Software stocks really moving to the forefront with the workforce moving to home-based employment. The need for this software is out there. And then from there, we can just drill down. We can see small cap stocks really getting damaged, down another 15% this week. So that's the broader markets, and then drilling down within. What I want to do from here is go ahead and share with you one other item on the broader markets, and that is what does a downtrend reversal look like? This is the downtrend reversal out of the 08-09 bear market, and we can see that the RSI, the MACD trending positively, and these nice big up moves as the downtrend is reversed and a break above these key simple moving average. We'll pay attention more to that down the road as we get closer to that potential possibility. For now, what I do want to do is share with you some of the stocks that are really, as I mentioned, holding up well. We've seen some developments among the with the FDA and the coronavirus testing. And I'm going to share with you a couple of stocks that are really interesting. So first is to share with you the news that yesterday the FDA did allow companies to declare what's called an emergency use authorization. So they are authorizing, in particular, these coronavirus testing kits. So 9 countries over the last week have received this emergency approval. Now, I will tell you only 3 of the stocks really look compelling. Not all of them are responding positively to this because the news is coming out, but the corporations are being very tight-lipped as far as their sales potentials. But the first name that we can take a look at is QDEL, and they were famous for flu testing. There's thinking that going out of this, there'll be an increased demand for flu testing, but they did get that emergency approval for coronavirus testing. And what I did want to share with you is this, it really is rather sloppy still as a price chart goes. Ideally, this is the kind of structure we want to see tightening up, tight trading ranges coming into an uptrend, but certainly worth noting. And this would be more for you, those of you that are not put off by the volatility, that you may want to trade, but even intraday, it's rather sloppy looking. So I would argue this particular stock would be potentially a longer term play. There's one other one that did get approved, and this is a really small stock. I have a client, a hedge fund that I work with that is very familiar with this stock. But really, it's just beyond sloppy. It's all over the place, but it is up 30%, something worth noting. And then one other stock that came out of this emergency approval without needing the FDA is CEODX. And this is one that I had pointed out a couple of weeks ago because they were in the forefront. So for those of you, this particular move up here was when the coronavirus first really became big news. It really was up over 80% on that move. So subsequent to that, we can just make a case for the possibility that it is forming this high tight flag formation as we draw here. So we could see an emergence out of that. A little bit of a stretch, but certainly worth noting. So beyond that area, there are other notables within healthcare that are certainly worth being aware of, and that is Regeneron, REGN. They are claiming that potentially by the summer months, they will have a cure that they could test on patients. So that is certainly another one within healthcare. So one other area that I wanted to really take a moment here and review is some of these stocks that are potentially bottoming, and we can review potentially why and what I would need to see to be convinced. The first area I talked to you about is software stocks. And again, there is great demand, particularly for those software companies that can help keep entire work departments, entire companies in contact with each other in a way that they can really keep their projects, keep their workflow going. This first one here is CRM. This is Salesforce, a big winner up here. And arguably, I mean, it has had a tremendous drop from this peak. So we are still early, let's face it, but it is worth noting that despite a broader market that was down over 13%, this particular stock, let's just take a quick look, and we can see it was up 8% on the week. So clearly some dynamics at play here. But what we can see is that this potential downtrend reversal was met with resistance at this green 10-day simple moving average. We're looking at a daily price chart. So what I would need to see before becoming interested in CRM, certainly one of the first would be a nice tightening up in this trading rather than this sloppy, huge advances that are taking place now. And then beyond that, a price break above these shorter term simple moving average combined with an RSI that is positive. Again, this is a daily price chart, and we would need to see that black line crossing up through the red on this moving average convergence divergence. That's your MACD. That is a momentum indicator. So I can really, there are about 10 different stocks that we can take a look at in software, but with this is with an eye toward the concept that software stocks are viewed as defensive. They have these ongoing when they do sign contracts, ongoing revenue source. So that is one stock. But let's take a look at some of the names that are holding up quite a bit better. And this, of course, is Zoom Video, ZM. This is a service that provides the ability to connect with other individuals. You can do webinars and others. And really, you would not know that the broader markets were in a correction in a bear market. So we've had this nice breakout on really heavy volume. RSI MACD is very positive. So a little bit extended here, but certainly a stock worth being aware of. And one other name I'm going to share with you, and then I'm going to move on because there are other areas before we get to the end of today's show that I want to share with you. But this is another potential bottom fishing that is taking place. Now, again, I'm telling you it's still a bit early, but this is VMware, very much involved in keeping people connected while at home. We can see that the RSI is emerging out of an oversold position. So we would want to get up above that 50, this moving average convergence divergence MACD just poised to turn positive here. We've had that nice break up above the 10-day simple moving average. Now, again, this is going to be for more nimble traders. We are still in an environment that is very headline driven. So with caution. How's that? One other name that we can take a quick look at is DocuSign. This allows the ability to have documents signed and shared virtually, or actually digitally would be a much better word. And we can see that this stock, again, a little wide and loose, a little sloppy, but constructive in that it pulled back to this upward trending 200-day simple moving average and is potentially reversing. We're very close with the RSI and the MACD. So I'll tell you, there are about 12 stocks that are all in that same space in the sense that they are software, but they are also promoting the ability for workers to stay connected while working remotely. Let's take a look at some other areas that are potentially trying to bottom, just again with an eye toward what to be on the lookout for. So this is CROX. And the reason I'm pointing this out, this was a big winner going into February. This drop is a 50% drop. Now, we are super, super oversold in this stock, but not yet ready for prime time because we would need to see this RSI get up above 50. We would need to see this super downward trending MACD at least have a black line up through the red. But it's one of those names that it's just so oversold. Maybe put it on your radar. We're going to keep an eye on it and see where it takes us. But outside of that, we are, of course, seeing really a lot of movement in the home grocery delivery division and everything to do with people being quarantined, wanting to stay at home. So we can take a look at Kroger. This was one of the first names out of the gate, so to speak, very well positioned to take advantage of online sales and delivery. So KR, we're looking at a daily price chart, nice orderly pullback to its upward trending 50-day simple moving average. And then of course, it really had this big spike in price here earlier this week. What I like in today's action is, and granted, this is going to be wide and loose. When I say pullback, that's a 7% drop, but it did find support at this upward trending 10-day after undercutting below it. RSI and MACD are in positive territory. When you're playing, if you are, and I don't mean to say playing, trading some of these stocks in this really super volatile period, it can be helpful to drill down and take a look at some of your shorter term charts. That's an hourly chart. Still looks super negative on that. I would need to see a move similar to this where the MACD trends upward, as does the RSI. But I think you can get a sense that despite we are seeing some positive action, we may be just a little too early here, given the fact that the volatility just remains high, and it will. The uncertainty is out there primarily because we're just not sure how far, how wide this pandemic is going to spread. So it is very warranted fear-based or uncertainty-based volatility. But here's UNFI, another food company, but again, wide and loose, but just clearly a bit in an uptrend. We can take a look at some of the larger stocks, and these are, I'm going to share two companies before we have to go ahead and end it for this week, but two companies that are actually hiring. This first one is Amazon. Big break with the broader markets. They've announced that they are going to be hiring at least over 100,000 individuals to cope with the over demand in their delivery service. That said, we are not in positive territory. We have a 50-day, this red simple moving average where the rally is being met with resistance. Our RSI did not turn positive. We're very close to having this MACD poised to turn positive. So one for the radar, not yet ready for prime time. And then one other company before we leave is also hiring. This is Walmart. They analysts are actually upgrading the stock. They are really well positioned. They're seeing huge growth, particularly in their grocery sales. This is something they've been setting up for years. They're now ready for prime time. But again, really wide and loose, a lot in the way of volatility. I would say keep it on your radar screen. This is the nice kind of move that we would ideally like to see. But I am going to leave it at that. I urge you again, take a trial of my MEM Edge Report, stock full of great information in this volatile period. Take care.